So long-term portfolio management, right? What we have discussed up till now is how do we do fundamental analysis. We understand the key ratios to do that, and we do that from a sectoral analysis perspective, so that you look at the wider industry, you come down to a company or a group of companies in that sector that makes sense for you with these key ratios, etc. Then you come down further and then choose the best out of the lot. And now you will do before you enter them, you do a technical analysis on the basis of what we did earlier in the short-term ones. Now, before you go there, let me quickly show you what you've downloaded and what does that mean, right? The key ratios again and how to see them. So we'll go there and see how that works. So if you see my screen, right? One of the shortlisting criteria I mentioned earlier also, it's called the Lynch criteria, which is choosing stocks upwards of $5 billion, right, of companies. So I do the same, by the way, be it, whichever part of the world. So then you talk about only a top, unless I have a personal interest or I have a peculiar interest towards small cap and the mid cap ones, right? So though this is 5 billion falls into the mid cap criteria also, upwards and there, I look at small cap sometimes because I told you cyclical motion and various other factors. Some of the small companies can do much better in that specific, like chemicals and the others or supply chain. These work very well. So sometimes I choose them, right? That time you have to overlook this criteria. Then there is, so thumb rule of Lynch was P should be less than growth rate, or and then so on and so forth. Okay, so the top layer, if you see, is the Lynch criteria on various factors. The one below is industry related ones, where the table below, if you see, okay, so I'm referring to the ones which are grayed out. Okay, the grayed out, that means the gray headings. Those are representing all the columns of each respective row. The rows that are suggested are all about the companies. Now, if you see, we start with the date, we start with the industry, all right, which industry that company belongs to, and you put the name of the company. Against that company, you put the CNP stands for the current market price, right? Then you see the industry P for that. What is it? The company P followed by company P, right? So then you gives you first criteria, that is the industry doing better, P of this company is doing better. So in the first company that we're seeing, maybe it's doing better, right? Much better means it is much higher than the industry P, which can also suggest it can come down. Okay, by the way, from a fundamental analysis perspective. Then earnings per share is 305. This is good enough, all right? This you compare with its other peers, right? How are they doing? And then you come to know it's good enough or not. Then you have the P by BV, right? This is the price against the book value, right? This is the criteria created for the Buffett strategy, right? Buffett ratio rather. So if you use P by BV is used against the PE in the next column, right? This, as I told you, doesn't work for the technology companies, but more so it should be less than 22.5 for the current company. And this is, I told you, not ready-madely available. You have to calculate this, right? So the P by BV has to be calculated, multiplied by the PE that you found out in the first one. Okay, hence the H column was formed. So it gives you a ratio. You see, the first one looks like a technology company, and with that, for a technology company, it has to get bypassed. As simple as that. Okay, because of the reasons I mentioned earlier. Then there's a PEG ratio. PEG ratio should be below 1. As simple as that, right? So again, earnings per share, if you remember, right? For $1 movement, what is the earning against $1 earning? What is the share movement happening? That's the way it is, right? Or number of shares available rather. Okay, so that's what earnings per share and the growth, earnings per share growth is. So with that said, if the PEG is below 1, that is the criteria. It signifies that it is in the green zone. So that's why the green has been mentioned. the return on capital employed, I said it has to be between 15 to 20%. This one seems to be even higher, right? Higher the better. Then there is, besides ROEs, there is debt to equity, right? Liquid ratio. Okay, so you'll see here these terms, right? Liquid ratio is what it means, right? It means debt to equity. That's the mathematical formula, if you will, for finding it out. So the liquid ratio is 0. That means this company has no debt. As simple as that. Okay, so it seems like a good one. It could be one of those IT companies like the TCS or the Infosys of the world. Okay, so and the next one is current ratio. Okay, what is current ratio? Right, assets upon current liability. You remember I mentioned this earlier that if you see the balance sheet and see the health, right? If you see assets against liability, this is what the current ratio would look like. The current ratio means that. So if assets is higher, current ratio, the liability is less, it has to be greater than 1, right? Ideally it should be, because it has to be between 1.5 to 2. The reason being, higher the better, that's not the count here, right? Because you have to have certain amount of debt in your company in terms of liability, right? Otherwise you're not using your efficiency of creating the growth which the sector would have otherwise, right? Because if your assets, right, that you have currently for purpose of using this, right, is 3 times the value than your liability. That means you're not creating enough assets out there and you're remaining with them. You have to create more liability so that you make more assets, right? But that ratio has to be within that 2. Okay, and the best ratio in the industry for growth ones are 1.5 to 2. Okay, you got the purpose. So you have to use liability, you have to create capital, you have to make more capital to ensure that there is your current assets are put to use in the right fashion, and the outcome that is coming out of is creating more liability for you, right? Liability in terms of borrowings, so that you can create more products like this, so the growth keeps on accumulating. Otherwise, after a certain point of time, your competition might take over you if you're not creating enough assets. Hence the 1.5 to 2. Then there is less than 10 of EV upon EBITDA, another important ratio, right? So again, EV is economic value, by the way, of an organization. Okay, and this means if tomorrow somebody is to buy you out, how are you valued at? That's what it means, right? Against your EBITDA. So this is has to be less than 10, right? Because your EBITDA, if it is higher than your value, right, that means your margin is higher than your economic value. That means your economic value is your margin is not good enough to match up with your economic value. That's what it means. Okay, so it's the other way around, right? Now, why 10? Because if you see the best companies out there and you see the EV against EBITDA against one of the Buffett ones, right? This is where it is, he's been able to suggest this through, because the economic value of an organization plays an important role in the overall health of an organization, right? But EBITDA is a live case scenario to see because EV has a lot of assumptions. The EBITDA is the real value out, right? That's a true margin that is coming out. So if the margin is not high and economic value is showing higher than that, right, that means your margin is not coming to the optimal level where it's supposed to be. Hence, it has to be less than 10. Clear? So that's what it means of economic value of an economic value against an EBITDA. So with that said, the next one is quick ratio, right? What does it mean? It means the asset against inventory, right? So inventory, if it piles up, it is of no good. It creates more liability for you. So inventory. So this quick ratio gives you the purpose of if tomorrow liquidation happens, right? Your inventory is good enough to match up with your assets, to equate your assets. That's what it means. So it should be equal to or greater than 1, so that the balance is maintained. As simple as that. What else? Okay, so I think this is good enough for now. You have, of course, the 52-week low and high, which you can understand why you should buy. And I mentioned the dividend yield, right? The higher, the better. That's what it means. Okay, I think this is good enough. You will understand everything else. And you see the green ones, those are the ones which have been tick marked of sorts. So the maximum greens is a company that you should be picking up and running with. That's what this means. Clear? And if while doing this, these key ratios, if maintained, right, the way we discussed the previous fundamental analysis, you will find your right company within this, right, by putting these criteria and then choose them and run with it. Okay, so I hope this gives you a good understanding on how this works. Okay, there are other tabs which you can use, and as soon as we cover that, you will relate to them accordingly. Okay, so now if you understood, again, this is a continuation of the key ratios from the previous times, and since it is already in the written matter which you can refer to, I just went speedily around with it. You can go into deeper details in case you have to, because the thumb rule should be maintained, because it still stays whole, right, even in the current scenario. Now the steps for management, right? Long term. So when we do analysis, you remember for the short term we did even a day or a week at max. In long term, you should do week and monthly only. Okay, don't go to days. Day at best you can choose for as an entry, right? That, is it gone to the bottommost level where I can start entering from? That's what a long time frame analysis would mean. Then quarterly, so evaluate the sectors and the company almost on a quarterly basis. That's the best way, the best practices to manage this. Then there is the PE and technical indicators. So keep a view on the price action, how it's going about, right? And verify it by your technical analysis. Now, in your previous one, we did not see a TSI. TSI is a true strength index, okay? One of the other indicators. Now, if it shows a crossover and going down, that's the time to get out of that stock, okay? So like an MACD, it is a TSI, which gives you it's used for that purposes when when it kind of, it doesn't do it doesn't show you a divergence, but it shows you actually that there is a reversal happening. That is the criteria of a true strength index, the TSI. So use that to your advantage, and once that happens, you might want to exit the particular stock and then re-enter when it reverses completely in the upward direction. Then news and quarterly performance, we discussed this, risk and risk management, right? So the stop loss that exists should be very prominently coming about, unless I told the reasons why you should move it down or up accordingly. And then you monitor the LOC mentioned here is a stop loss, which means the line of control, okay, which you can manage accordingly, either to reverse pyramid to get out in sequential steps, or check that as a reversal mode. If it touches and the graph goes up, then you go pyramiding yourself even higher by averaging yourself through for a long-term basis. Okay, so this is what a long-term strategy was all about, and you understanding the key ratios as a continuation. With that, there's a challenge, and I will see you in the next one to understand the challenge.